China's first quarter GDP for 2025, the numbers are out.
Yes, and they came in at 5.4% year on year.
Which is actually better than many were expecting, right? The Reuters poll was looking for about 5.1%.
Exactly. And it also matches the growth rate we saw in the previous quarter. So some consistency there.
And looking underneath that headline number, what were the main drivers? The material suggests strong consumption and industrial output.
That's right. Retail sales in particular showed a pretty significant jump in March.
How significant are we talking?
5.9% compared to the same month last year. Now, that's actually the fastest pace of growth for retail sales in, well, over a year.
Over a year. Okay, so that does point to something changing with consumers.
It seems so. And on the other side, industrial production was also quite robust. It climbed 7.7% year on year.
Right, 7.7%. So factories were busy too.
Definitely. Taken together, those figures do paint a picture of, well, fairly solid economic momentum at the start of 2025.
And what's fueling this? There's mention of government stimulus playing a role.
Yes, that seems likely. Government measures aimed at boosting both consumption and investment appear to have had some effect.
Can you just briefly touch on how that works? Stimulus measures?
Sure. I mean, it can be things like tax breaks, maybe direct support, or increased government spending on big projects. The goal is always to get more money flowing through the economy.
Either by encouraging people to spend or by creating activity through projects.
Precisely. More cash in pockets, more demand, or more jobs from infrastructure work. It looks like those efforts contributed to the strength we saw in retail and industry.
Okay, so a positive start on the surface. But the outlook seems a bit clouded, doesn't it? Particularly these escalating tariffs from the U.S.
Yes, that's casting a pretty significant shadow. The big worry is the impact on China's exports,
which have been such a key engine for growth for so long.
Exactly. The U.S. is a huge market. Higher tariffs mean Chinese goods become more expensive there,
leading to potentially lower demand hitting manufacturers.
Correct. Analysts see these tariff hikes from the Trump administration as a major challenge to China's export sector and potentially its overall economic stability if exports take a serious hit.
And it's become a back and forth, right? Beijing implementing retaliatory tariffs.
Yes, the classic tit-for-tat scenario. When one side raises tariffs, the other often responds.
What are the broader implications of that kind of trade conflict?
Well, it creates uncertainty first off. It can disrupt supply chains, raise costs for businesses in both countries, and ultimately mean higher prices for consumers.
And the fear is this drags on.
The fear is a prolonged conflict, yes. Yeah. Which wouldn't just hurt the U.S. and China, but could easily ripple outwards and affect the entire global economy.
So even with that strong Q1 GDP, there are these underlying concerns. The material we looked at flags the sustainability of that export growth.
Right. Is the recent strength genuine, or is some of it maybe front-loading?
Front-loading. You mean rushing shipments?
Exactly. Factories trying to get goods out the door before new higher tariffs kick in.
Ah, okay. So that could inflate the numbers temporarily.
Potentially, yes. The worry is that if that's happening, we could see a pretty sharp drop in export performance in the months ahead once those advanced shipments dry up.
That makes sense. A kind of sugar rush before a potential crash. What about other domestic issues? The sources mention unemployment and deflationary pressure still lurking.
Yes, those haven't gone away. Deflationary pressures falling prices can sound good, but it often signals weak underlying demand.
Because if people aren't buying, businesses might cut prices.
Right, which then hits profits, maybe investment, maybe hiring. The persistence of these pressures suggests demand isn't firing on all cylinders yet.
And unemployment.
The urban surveyed rate was 5.3% for the quarter, though it did dip slightly to 5.2% in March.
Which is an improvement, but still
indicates a fair number of people looking for work, which can weigh on confidence and spending. It points towards an uneven recovery.
And then there's the property sector. That seems to be a persistent drag, with investment falling quite sharply again.
Yes, down 9.9% year on year in the first 3 months. That's a significant drop.
Why is property so central to the picture in China?
Historically, it's been a huge driver of GDP. Think construction, steel, cement, furniture, appliances. It touches so many areas.
Yeah, household wealth too, presumably.
Absolutely. Property often represents a large portion of household wealth. Falling investment and potentially falling prices can make people feel less wealthy and more cautious about spending elsewhere. Plus, local governments often rely heavily on land sales for revenue.
So weakness there really echoes through the whole economy.
It certainly does. It's a major headwind to factor in alongside the positive GDP number.
Given this mix, the Q1 growth, the trade tension, property woes, it's maybe not surprising that some global banks are starting to lower their forecasts for the full year.
No, it's not surprising. The sources mentioned UBS, for example, downgrading its 2025 forecast to 3.4%.
Which is quite a bit lower than the government's official target.
Right, the official target is around 5%. These banks are clearly concerned about the potential impact of the trade war, the property slump, and those deflationary pressures we talked about.
They're hedging their bets, essentially.
They're factoring in the increased risks and suggesting that hitting that 5% target might be, well, quite challenging.
Now, policymakers in Beijing seem aware. They're saying they have ample room and tools to act. What might they actually do?
They have a toolkit, yes. On the fiscal side, think government spending, maybe more infrastructure, or tax cuts to boost incomes.
Direct injections into the economy.
Yes. And on the monetary side, the central bank could cut interest rates, making borrowing cheaper, or adjust bank reserve requirements to encourage lending.
And the focus seems to be on consumption.
That's what's mentioned. So maybe measures directly aimed at getting households to spend more, things like vouchers or subsidies, perhaps.
There's also talk of a potential major fiscal expansion to counter the tariff shock, but then there's the Fitch downgrade.
Ah, yes, the credit rating downgrade. That complicates things.
How so?
Well, a major fiscal push means more government borrowing, more debt. Fitch downgraded China's rating, citing rising government debt concerns.
So spending more could worsen that perception.
It could. It's a balancing act. They need to support growth, especially if exports suffer, but they also need to manage the national debt and maintain investor confidence. Too much stimulus could raise borrowing costs down the line.
A tricky position. Still, the material does point to some potential buffers, some resilience. Domestic demand, for instance.
Yes, China's huge domestic market is a major advantage. As incomes rise, domestic consumption should become a more powerful engine for growth, making the economy less reliant on exports over time.
So stronger spending at home could cushion an export slowdown.
That's the hope. And linked to that is the push towards innovation.
Moving up the value chain.
Exactly. Developing new technologies, supporting high-tech industries that creates new growth areas, and boosts long-term competitiveness, potentially independent of traditional export markets.
That structural shift is seen as key then.
By some analysts, yes. A shift towards domestic demand and innovation could help navigate these choppy waters.
And what about exports themselves? Is the picture changing there? There's mention of diversification and homegrown brands.
That's also important. Reducing reliance on a single market like the U.S. is strategically smart. Building trade with other regions, like countries in the Belt and Road Initiative, help spread the risk.
So if the U.S. market cools, perhaps others can pick up some slack.
Potentially. And the rise of Chinese homegrown brands is significant too. If domestic companies become more competitive internationally and more popular at home, that also builds resilience.
Less dependence on foreign demand and foreign brands.
Right. It strengthens the domestic economy and provides alternative export avenues.
It really is a complex picture then. Strong start to the year, but some serious clouds gathering, particularly with the U.S. trade situation.
Absolutely. And the ongoing issues within the property sector and with overall domestic demand add another layer of complexity.
As the sources say, the next few months seem pretty crucial. We'll need to see how hard these tariffs actually bite and how effective Beijing's policy responses turn out to be.
Indeed. It's a very fluid situation, lots of moving parts to watch.
Well, that seems like a good place to leave it for today. We've covered the surprisingly strong Q1 GDP, the forces behind it, but also the significant headwinds from trade tensions and those persistent domestic challenges. The interplay here will really shape China's economic path for the rest of 2025. Thank you for joining us and sharing your insights.
My pleasure. Always interesting to unpack these developments.
Thank you all for listening. We hope you found this discussion valuable. Please do consider subscribing if you'd like to stay updated with our analysis on key global topics. We'll be back soon.